we kick things off here?
Okay.
Hello, everybody. Name is Alex Sasso. I'm joined here with Michael Simpson. Today is Wednesday, November 17th, 2021. This Zoom presentation is in Zoom presentation mode. What that means is your cameras are off and your mics are muted. If you want to ask questions, please do so using the Q&A button at the bottom of the screen. We'll endeavor to get to your questions. We've got a pretty full agenda today. And if we're unable to answer your questions, please contact your regional NCM wholesaler at sales@ncminvestments.com. So on the agenda today, so a couple different topics. We're going to be talking about Mike's one-year milestone managing the NCM NORIP fund. Congratulations, Michael. And also, we're going to be introducing a new segment. We've called it Rapid Fire internally, where Mike and I ask each other pretty quick questions that come to mind. Some of those questions have been seeded by you, the advisor. So thank you in advance for sending in some of those questions. We call it Rapid Fire, and the endeavor here is that Mike and I will try to keep our answers relatively short. We've noticed in the past, particularly with me, my answers get to be a little bit long. So we'll try to tackle more topics and keep the answers relatively short in the second segment of this podcast. So first, let's begin with Mike's one-year anniversary, and let's talk about performance. So as you know, with mutual fund legislation, all of these figures are after fees. So the NORIP fund, the NCM NORIP fund F class was up 29% for the 1 year ended October 31st, 2021. A very healthy number, and one that I would say most clients would be very happy with. The year-to-date number, the fund is up 19%. The fund has 40 positions, and Mike, I was surprised to see this. 71% of the names are in Canada, 25% in the US, with a small weighting in cash. Your biggest sector bets are industrials, followed by financials. And then in terms of size of company, most of the portfolio is in what we call giant and large size businesses, but you do sprinkle a few acorns in the small and mid-cap size market segments. We ran your fund attributes, and I see that the enterprise value to EBITDA for the entirety of the portfolio is a very attractive 11.7 times. To give the audience a flavor of how attractive that is, the TSX is currently at 21 times according to Cap IQ. Free cash flow yield is 6.5% versus 5% for the TSX. And the ROE is an impressive 21.5% versus sub 14 for the TSX. Your margins are higher, your sales growth is better. It's very NCM-like. But the most important stat that I came across, the most impressive stat I came across, was the return on invested capital for the portfolio was just under 14%, the TSX at 7.7%. So very impressive attributes. And to me, attributes like that over a business cycle tend to outperform. And as we all know, Mike has a very stellar career of outperforming. He's one of Canada's best decorated portfolio managers, and it's a pleasure being able to work with him. But perhaps that's a good lead into my first question for you, Mike. In terms of your investment methodology, maybe just give the audience a feel for how you think of the portfolio in its entirety.
Okay, thanks, Alex, and hello to everyone. I look at a portfolio, I want to make sure it's diversified. I'm looking for cash flow growth in companies. I'm looking for companies that can actually generate free cash flow. That's after paying interest, reinvesting in the dividend, reinvesting in the company, which is called CapEx, and paying dividends. I also want to know a company that can withstand shocks, whether it's internal and external. So over the last couple of years, we all know that the world has experienced many unknown shocks. So shocks that are specific to a company may include rising input costs, commodity costs, rising labor costs, et cetera, et cetera. So it's a portfolio built for all seasons. It's a portfolio that my mother can invest in. It's a portfolio that I've invested some of my wealth in. I like to invest in what we call at NCM, the dividend champions, companies that can consistently raise their dividend every year. So that's the essence. It hasn't changed since I've been managing money for more than 20 years. And that's what we're accomplishing at NCM right now, Alex.
Wonderful, thanks. And then, you know, this past year wasn't your normal type year, but maybe tell us what worked, what didn't work, and maybe a lesson or two that you learned.
Sure. So first we'll start what didn't work. It's more specific names. Within the software sector, there was Enghouse, which had a very strong 2020 as various work from home restrictions were lifted. Some of their software dealing with call centers, they just didn't get as many users. So we still like that name. It generates a lot of free cash flow. Management does acquisitions, but they're very disciplined. So we like management's focus on the balance sheet, return on invested capital, return on equity, etc. Another name that's used to be run by the former finance minister, Mornell Chappelle, now called Lightworks. It actually was performing quite well. They released a quarter. They missed on revenue and EBITDA, but we think that's an opportunity. So we still own it. It's in our top 10, and we've actually been buying on weakness. So very resilient revenue, a very high percentage of recurring revenue, over 95%. In terms of what's working, very strong market. So in line with our thinking, the financials worked well, industrials for the most part, and materials, natural resources. So we won't break down the natural resources right now, but those are some of the sectors that have been working.
Yeah, nice. Thanks for that. I'm discovering that, you know, the back half of 2020, the first half of 2021, it felt like, you know, the rising tide was lifting all stocks, and now there's a little bit of separation happening in the marketplace, and there's a little bit of back and forth between value and growth, most recently with growth. But Mike, talk to us about how the portfolio is currently positioned.
Yeah, as I mentioned earlier, we think the best approach for 2022 and beyond is a barbell approach, because as the economy recovers, we think we're in mid-cycle because we've had the interruption of COVID. I want to see financials. A recovering economy means the banks can loan more, the loans on their books will not be impaired, and also some of Canada's blessing of great natural resources, from canola to natural gas to propane, to other natural resource commodities, should do well. So think of the portfolio as financials on one end, and then you have industrials, which could be a railroad delivering the bulk cargo to port, and also some other natural gas stocks, such as a resource-focused stocks, such as a Nutrien producing potash, or some of a natural gas liquids company like Tourmaline or Arc Resources. So that's the best way to think of the portfolio right now. And there'll be what we call some acorns in there and some other sectors, just to round out the diversification of the portfolio.
Yeah, nice. Let's move to the next section.
Sure.
Of the presentation here. We'll sort of ask questions back and forth, and as I said earlier, endeavor to keep our answers relatively short. I'll start, Mike. COVID-19, not hearing as much about it these days, but is it still impacting stocks, or are you seeing opportunities that it's providing?
Oh yeah, good question. So, you know, we've been dealing with COVID for a while now. So there's some stocks that naturally benefit. A company like Cargojet, think of COVID impacting basically all aspects of the economy, all industries, all sectors. So Cargojet, they have the dominant share, over 90% of overnight cargo in Canada. As online ordering has boomed, their business has gone up. They have great contracts with Amazon, DHL, and others. They benefit from a rule called cabotage, where a foreign player cannot come into Canada. However, there's always a however, with some of the lockdowns and some of the government support programs. You know, they've had to raise wages for some of their workers. In some cases, there's been a shortage. Another company that has benefited has been Transforce. Trucking rates have been very strong. They've expanded into the US. and they're also taking advantage of the e-commerce boom. And as I mentioned, Lightworks, employee assistance programs, a lot of stresses, a lot of mental health illness issues. However, demand for counselors is very strong. They've had to pay higher wages, but in essence, there was a summer quarter. They missed by a little bit. Their stock was overly punished, and I like this name, and I'm sticking with it. Now, if I could ask you a question, Alex, Canada has underperformed for many years. It's a small country, small in terms of GDP. Why would an investor invest in Canada right now?
So the simple answer is it's Canada's time. Global synchronous growth. We've got a goods-led recovery. We've got significant underinvestment in the materials and oil and gas sectors in this country. There hasn't been a major copper discovery in a decade for many years. As you guys know, it takes over a decade to find a resource and generate $1 of revenue out of that property. Not only that, but you've got a faster earnings growth in Canada right now, and you have a significant valuation discount. In fact, I've got a couple slides. Can we throw up the slides on the webinar here, please? And I'll be quick taking the audience through these slides, but I think they're really interesting. I mentioned Canada trading at a valuation discount. What we're showing you here is on the blue line, the TSX. On the black line, you see the price earnings multiple of the S&P 500. If I take your eyes to the far right of the chart, you see that the S&P 500 trades at 12-month forward operating earnings of 21 times, the TSX of 16. And then if you scroll your eyes along those two lines, you rarely see a time period where you have a discrepancy in valuation that much, especially during a period where earnings are growing faster in Canada now than they are in the US. So the composition of the US market has changed, yes, agreed. But again, I think Canada will have its day in the sun, and there's every opportunity to do so, especially with some of the structural changes, the disruptive changes that we're going to be seeing in the marketplace that commodities are going to play a major role in. If you want to switch to the next slide, please. Speaking of commodities, I do have a slide on commodities here. Here we're showing you two indices. I'll take your eyes to the red one. It's the CRB spot industrials without energy. You can see on the far right-hand side what's happened to commodities. This is good for Canada, obviously, and is good for a big segment of the Canadian market. And then the last slide, if you can just forward to the forward earnings yield slide. Here we go. The blue line is the TSX forward earnings yield, and then we got the 30-year Canada bond yield. And I apologize to the bond guys, but equities is the most attractive asset class, in my opinion, especially where dividend yields are and where those 30-year Government of Canada bond yields are, where inflation is relative to it. And interesting enough, there's a lot of empirical evidence that show that even with higher interest rates, the equity market can still perform 12 and 24 months after higher interest rates. But so anyways, just to summarize, Mike, we're seeing a good market. We're seeing a good market in Canada. This has led to a lot of new issues and IPOs. It's a good segue into my next question for you. Is with some of these new issues and IPOs, we saw a tidal wave of them early in 2021 and throughout the spring and summer, and then they kind of petered out. And it just seems like in the last few days, we're starting to see a bunch more. They've come back with a vengeance here recently. Just your thoughts on that?
Sure. There is a seasonal element to the market. This is the time of the year when analysts start to come out with their forecast for 2022. Beginning in January, there'll be a lot of excitement. People will look for the January effect. there's certain studies that show that small cap companies do perform better in the first few months, in particular the month of January. So we did have a cycle that went approximately from January, call it, to the end of June, as there was a plethora of issues, as the initial few performed very well, and then subsequent IPOs did not perform well. You could say the market became petered out, and as some of the IPOs issued in May and June, these were high revenue, high growth companies, not a lot of earnings, in some cases, not even EBITDA yet. So the market was just saying enough's enough. And it took a breather over the summer, even part of the autumn. And now we're starting to see a few more. It's debatable, or I guess it's early days to see how this new crop will perform. In this round of IPOs is a larger, call it demutualizing insurance company, the former Economical Insurance, now called Dividend, is IPOing. So that is a bit different than the traditional technology companies, or the technology companies that IPO'd earlier in the year. But I would say it's always for investors, especially the NCM buyer beware. And we do our works, we read the prospectus, and we don't want to pay too much for a growth multiple that may slow down, and we just don't want to be left holding the bag.
Yeah, and that's a great point. I see that there's a lot of companies out there, Mike, that would be subpar. They're trying to take advantage of a frothy tech market. And then at the same time, there's some really high quality companies that have come public and we're really excited about, particularly for me on the small cap side. You know, there's Thinkific, there's Magnet Forensics, there's some really, really interesting new technology companies. And I'm really proud of so many of these Canadian entrepreneurs. Nuvei is another. There's a whole bunch, Lightspeed, there's a whole bunch that come to mind that are, you know, growth companies that are disruptors, and really excited to see this new crop of companies become available to us as public company investors.
Alex, when you find a great company, great management, good growth prospects, where do you draw the line on valuation? Because I think the easy part for investors is finding a great company, but the hard part is sometimes pulling the trigger.
Yeah. And, you know, Mike, our investment methodology kind of helps us with this because, you know, we just don't buy the no revenue, super high multiple stocks that are out there. So we buy companies that are no story stocks, no fad stocks. These are very high quality earnings, EBITDA, cash flow, free cash flow generating companies. The metrics on the portfolio, much like the metrics on your portfolio, are great because our companies grow faster than the market, than their industry, and yet trade at a discount. So our quants really help us with that. Our roll up the sleeve fundamental work really helps us with that. But like you said earlier with your portfolio, I often use the analogy of a soccer team or a hockey team. You don't want 11 Ronaldos on the field at the same time. You need one or two Ronaldos. You need a good crop of defensemen, and you need a good goalie. So much like with a portfolio, you need balance in the portfolio, and then you tilt it based on where you think you are in the business cycle. And if you think you're in the growth section of the business cycle, you overweight the growthy side of the portfolio. And if you think that the market could slow down, then you overweight the defensive side of the portfolio. But that's how, you know, we think of it. And then the other thing is there's a lot of bad companies in your benchmark and in my benchmark, and the objective here is to not invest in those bad companies and to root them out. And then to make sure you don't have any torpedoes in the portfolio, because the torpedoes are what kill you. And those super high multiple stocks, those are often the ones that could become a torpedo. As soon as those growth rates get ratcheted down, you and I have seen it dozens and dozens of times in our career. The market very, very quickly re-rates these things. There's a company today called Good Food. It was a high multiple, rapid growth company, released earnings today, surprised the market. Stock's down over 21% today because earnings expectations did not meet investors' expectations. And so we tend to shy away for those companies, from those companies.
Excellent.
Speaking of growth rates and interest rates and inflation, just your thoughts, Mike. I know everybody on the call is curious about this, and it's been the theme of the last few months. Just your thoughts on interest rates and inflation.
Yeah, early on in my career, from a good teacher, I was taught there are two main drivers in the stock market: interest rate and earnings. So on the question of interest rates, the listeners have to remember we're at emergency levels, we're at record rate lows because the central bankers wisely had to respond to a once in a century pandemic and virtual demand destruction overnight. So my view is that with the inflation that we're seeing, some of it is coming from known and some of it's coming from, call it, non-traditional sources. We will get rates that rise next year. It'll be moderate. Remember, our basis points is 25 basis points in both Canada and the US. So I think they can rise by 75 basis points. That's a really small amount. And inflation will subdue sometime, I believe, in mid 2022. I study quite closely the Port of LA Long Beach statistics. It shows that inbound traffic or containers peaked in August. So slowly we will start to decongest the bottlenecks of the vast supply chain. But my views are that inflation, although it looks very high right now, over the next 12 months, it will come down.
Yeah, I fully agree. I think, once inventories normalize, and I'm not saying we're close to inventories normalizing, but much like 2021 was the year of supply chain disruptions, 2022 will be the year of supply chain normalization. And once we start seeing supply chain normalization, you're going to see inflation expectations ratchet down, because if you're in the market for a new gray F-150 and you go to your dealer and he's got 6 of them on the lot, and his competing Ford dealer in the next county has 6 gray Ford 150s on the lot, because the supply chain is normalized, guess what? You're not paying full retail like you are right now for that vehicle. Those prices will come down. And as those prices come down, people will reset their inflation expectations. And as a result, they'll start to believe the often overused, it's transitory word. And I don't think it's 100% transitory, but I certainly don't think inflation is going to remain at the elevated levels that we're seeing right now, because of all of the friction we're seeing getting parts to factory floors. So anyways, thanks for that, Mike. I just thought I'd throw in my 2 cents there.
Excellent. Just Alex, I mean, you take a bigger view of the economy. Where are you seeing the most disruption? And disruption can be anything from software to manufacturing to anything, and any sector of the economy from A to Z.
Yeah, it's a question that probably needs a half hour. There's so many different segments of the economy we're seeing disruption, but certainly the auto business over the next 5 to 10 years will see significant disruption. I would fathom a guess that the next car, a good percentage of our audience goes to the lot to buy, maybe an EV. It will not be, chances are it might not be a combustion engine vehicle. That is going to have significant repercussions through that whole supply chain. And if you think about it, battery technology is improving significantly, electrolyzer technology is improving significantly, cathode technology is improving, but they all require raw materials, and those raw materials are it's copper, it's nickel, it's cobalt, and a whole bunch of others that are difficult to get out of the ground. I mentioned earlier that we haven't seen any significant copper discoveries in quite some time. If we saw a chart of the significant discoveries over the past couple decades, a decade and a bit ago, we saw some because there was a significant amount of capex being poured into drill holes. We're just not seeing it. We haven't seen it for some time. My point is that copper is going to become more in demand, and it's one of the reasons why we're seeing $4 in copper cent prices. But there's a lot of different ways we can play this disruption. So it doesn't just have to be the mining companies, but certainly that's one way to do it. You can play the electrolyzer companies. You can play the battery companies. You can play the auto parts companies. You can play the auto companies. It's really interesting to see Lucid. It's a brand new EV startup. Doesn't have $1 of revenues, but it's got a market cap greater than GM, and it's got a market cap, equivalent of GM, and it's got a market cap greater than Ford. You look at Tesla, $1 trillion market cap. Its market cap is greater than Ford and GM combined, as well as many other named auto companies. Anyways, the market is basically saying that disruption's coming. All these new competitors are coming. We think Apple's working on something in the space as well. And don't forget about recycling technology, battery recycling technology. Not a lot of people talk about this, but this will be a segment that we're spending a lot of time on learning, but it will be a significant growth segment as these rare earths are very difficult to find. It's a heck of a lot easier to take that battery and recycle it. So that's one. Software is another one, particularly on the supply chain side. And we got some great companies in Canada. I'm going on too long here, so I'll just highlight. Kinaxis is just a market darling, a wonderful company. It comes with a big multiple, but there's Texas as well, and we own Texas in our small companies fund. Again, it is just a wonderful company. It's growing significantly. It's a recurring revenue business, but it's disrupting the healthcare supply chain fields, and we think it's got a really good long runway of growth ahead of them. So, okay, Mike, we're getting long in the tooth here. So I apologize. I promised I'd keep my answers short, and I just have difficulty doing it. But maybe just very quickly, a couple last questions here. Early cycle, mid-cycle, or late cycle?
Okay, I believe we're mid-cycles. Some of the evidence I would point to is you look at sales. I think sales are strong based on robust demand. We're going through an inventory rebuilding cycle. We're also going through a many years and decade reshoring process. So we're definitely mid-cycle. Investors should not get concerned about a recession or the business cycle ending. We're going to come out of COVID. We're going to rebuild inventories. We're going to put some of that demand to work. We're going to get more people to work in the service industry. So mid-cycle, Alex.
Okay, yeah, I tend to agree with you. Although this cycle is a little bit different in that all these supply chain disruption issues means that there is this pent-up demand that hasn't been filled yet. So we are going to see a period of 2022 in which the factory floors are going to be ramping faster than sales. And that's going to be a good thing. It's going to provide a tailwind for a lot of these goods-based companies. And at the same time, we've got the services sector that's opening up. So it's kind of exciting. There's the COVID losers. There's some segments of the COVID losers that still have not rebounded, that are providing opportunities, and we're doing our homework on those opportunities. But as we start narrowing it down to companies, maybe Mike, just 30 seconds on one name.
Okay, Alex. Lightworks, as I mentioned, the former Morneau Chappelle, they had a quarter. It missed on analyst expectations for revenues and earnings. However, they're doing quite well. They're growing their revenue. They're a global company. As I mentioned, mental illness among employees is on the rise. Some higher labor costs. So I like this at all. The valuation has come down. It trades much cheaper than U.S. peers. And I'll just give you I'll give a little bonus. Visa, it's come down in valuation due to the buy now, pay later fear. And also today there was some concern there in a little spat with Amazon in England. But that's less than 1% of their revenues, and it's meaningless. So if I can buy a great growth company like Visa at 23 times when it used to trade at 32, I'll do it.
Well, I'll tell you, I donate to Visa every month. So yes, I can see why that's been a growth company. I'll give 30 seconds on a name as well, and then we'll shut things down. So Hardwoods did an equity issue last night, and initially I was a bit disappointed, and then after learning what the proceeds were for, it's for more acquisitions. So they just did a really large nouveau acquisition for which they which they financed with debt, $300 million of debt. That acquisition has performed extremely well for them. Last quarter was a spectacular quarter, and the use of proceeds are to buy more companies like Nouveau. Not saying it's going to happen, but that's the objective, and management's getting ready for it. This is a very high quality management team that's still experiencing some strong tailwinds. Significant synergies. They tend to be really good acquirers. And it trades at 8 times enterprise value to EBITDA for a company growing at this rate of growth. There's not too many opportunities like this, in my opinion. It's one of our biggest weights in the portfolio. Mike, you've been great. Thanks for your participation today. Thanks for participating in the rapid fire segment here. Thank you to the audience. Really appreciate your time. We went a little bit over, but if you have any follow-on questions, again, please contact your regional NCM wholesaler at sales@ncminvestments.com. Have a good day, everybody.
All right. Thanks for your support.